Growth stocks can offer opportunities that truly reshape an investor's financial future. When an investor is prepared to accept a moderate amount of risk, the potential reward can be extremely significant. This is especially true when it comes to turnaround stories, which are situations where a company that once struggled manages to reinvent itself and achieve impressive growth. It is important to emphasize that not every struggling growth stock will recover or transform into a major winner. Some companies may continue to falter and ultimately fail. However, when a recovery does occur and the business begins to thrive, the returns for investors can be exceptionally large. There are three specific companies that illustrate this idea perfectly. Each of these businesses was unprofitable only a few years ago, which led many investors to doubt their ability to compete. Despite those concerns, all three have successfully turned their situations around and now stand among the most compelling growth stories available on the market. To demonstrate just how dramatic their turnarounds have been, consider how much a $7,000 investment in each of these businesses would be worth today. The first company on this list is Palantir Technologies, which specializes in data analytics. Over the past several years, Palantir has captured significant attention from individual investors who have been eager to participate in its rise. A major factor in Palantir's recent growth is its adoption and integration of artificial intelligence, which has allowed it to create new opportunities for expansion and revenue generation. Chief Executive Officer Alex Karp has also been particularly effective at communicating Palantir's long-term potential, which has helped maintain excitement among investors. In its most recent quarter, Palantir achieved a major milestone by reporting more than $1 billion in revenue for the first time in its history. This represented a 48% year-over-year increase. In addition to revenue growth, Palantir posted net income of $326.7 million, which demonstrates how far the company has come since its earlier struggles, which shows just how dramatically its financial health has improved. The strength of Palantir's recovery can be seen in its incredible stock performance. Palantir has provided returns exceeding 2,600%. For an investor who placed $7,000 into the company at that time, the value of that investment today would be nearly $193,000. This kind of growth highlights the power of turnaround stocks when the recovery is successful. At the same time, Palantir's valuation has reached a level that may concern some investors. Its price-to-earnings ratio now exceeds 570, and it holds the highest price-to-sales valuation of all companies in the Standard & Poor's 500 index. These numbers suggest that the stock could be running out of room for further rapid appreciation. Palantir has become one of the most expensive stocks on the market, which means investors should weigh the potential for future gains against the possibility that its valuation might eventually compress. Moving on to the second company, AppLovin has outperformed even Palantir over the past couple of years. AppLovin operates in the advertising technology sector and, like Palantir, has turned to artificial intelligence to strengthen its business model. Its Axon artificial intelligence platform connects advertisers with publishers, allowing it to match advertising demand to supply more effectively. This system is designed to reduce unnecessary spending while maximizing returns on advertising investments. Even more remarkable was the company's earnings, which totaled $820 million, representing a 164% year-over-year jump. These results indicate that AppLovin has achieved outstanding profit margins, which has enabled it to scale its operations efficiently and improve its overall financial position. Because of its profitability and rapid growth, AppLovin could eventually reduce its relatively high price-to-earnings ratio. At the moment, the company trades at approximately 90 times earnings. However, when analysts look ahead, they estimate a forward price-to-earnings ratio of around 46, which appears more reasonable given the company's growth trajectory. While AppLovin remains an expensive stock, its valuation is not nearly as extreme as Palantir's. Its excellent profit margins and faster growth rate could make it the more attractive option for investors seeking exposure to artificial intelligence and digital advertising technology. Nevertheless, AppLovin is not without risk. Its stock has skyrocketed by more than 5,800%. This extraordinary performance means that a $7,000 investment would now be worth over $413,000. Such outsized gains demonstrate that stocks with higher risk levels can also offer extraordinary rewards, but they also underline the importance of carefully evaluating whether such growth is sustainable over the long term. The third company on this list is Carvana, which runs an online platform for buying and selling used cars. Only a few years ago, there were serious concerns that Carvana might face bankruptcy. The company had taken on significant debt, was dealing with high costs, and was operating in a difficult economic environment. For investors at the start of 2023, buying Carvana shares would have appeared to be a highly risky decision. However, Carvana has executed a successful restructuring plan that stabilized its operations and helped restore confidence. In addition, the renewed interest in meme stocks among individual investors has played a role in lifting Carvana's fortunes, as more people became willing to speculate on its recovery. Carvana's financial performance today is a sharp contrast to its earlier struggles. In the June quarter, the company reported a profit of $308 million on revenue of $4.8 billion. This revenue represented a 42% year-over-year increase. However, investors should keep in mind that Carvana still carries significant risk. Its profit margins remain very thin, which means even small changes in economic conditions could affect its ability to remain profitable. If tariffs or other economic pressures reduce consumer demand for used cars, Carvana's financial performance could be negatively impacted. Still, since the start of 2023, Carvana has delivered an astonishing return of over 7,800%. A $7,000 investment in Carvana at that time would now be worth nearly $559,000. When we look at these three companies together, the results are remarkable. If an investor had allocated $7,000 to each of these stocks, the total portfolio would now be valued at more than $1.1 million in under 3 years. This level of growth shows how powerful it can be to invest in turnaround stories, provided the investor is prepared to handle the risks associated with such investments. It also serves as a reminder that while not every struggling company will recover, those that do can produce returns that far exceed the market average. Three former underperforming companies, Palantir Technologies, AppLovin, and Carvana, have transformed into some of the most impressive growth stories in the market. Palantir leveraged artificial intelligence to surpass $1 billion in quarterly revenue, achieving 48% year-over-year growth and posting net income of $326.7 million after previously recording heavy losses. AppLovin, also powered by artificial intelligence, reported $1.3 billion in revenue, a 77% year-over-year increase, along with earnings of $820 million, representing a 164% surge. Carvana, once at risk of bankruptcy, restructured successfully, reported a $308 million profit on revenue of $4.8 billion. $7,000 investments in these companies would now be worth nearly $193,000, over $413,000, and almost $559,000 respectively, creating a combined portfolio exceeding $1.1 million. With that being said, I will see you in the next video.